Good day, and welcome to the International Fixed Income Webcast. Today's call is being recorded. At this time, I'd like to turn the call over to Ms. Barbara Van Every, Director of Investor Services. Please go ahead, ma'am.
Thank you, David. Thank you and good afternoon. Welcome to the DoubleLine Funds webcast with portfolio managers Su-Fei Ku and Bill Campbell. The title of today's webcast is The Long Road to Recovery. Today, Ms. Ku and Mr. Campbell will be going over 4 DoubleLine funds. The DoubleLine Emerging Markets Fixed Income Fund and the Low Duration Emerging Markets Fixed Income Fund are listed here with the different expense ratios and minimums. They will also be covering the DoubleLine Global Bond Fund and the Emerging Markets Local Currency Bond Fund. Here you can see the different expense ratios and minimums. I'd like to go through the standardized performance for all 4 funds quickly. First is the DoubleLine Emerging Markets Fixed Income Fund, which was launched April 6th of 2010, one of our very first mutual funds launched in the DoubleLine Fund complex. As you can see here, the annualized return since inception through October 31st of this year was 5.5% annualized. The DoubleLine Low Duration Emerging Markets Fixed Income Fund was launched April 7th of 2014 through October 31st of this year, an annualized return of 2.94%. The DoubleLine Global Bond Fund was launched December 17th of 2015 through October 31st of this year, an annualized return of 1%. And lastly, the Emerging Markets Local Currency Bond Fund, which launched June 30th, 2019 on DoubleLineFunds.com. Some announcements. Next up is Jeffrey Gunlock and Andrew Su discussing the Total Return Bond Fund on December 7th, followed by Ken Shinoda covering the Income Fund on December 14th. If you'd like to receive a copy of today's slides, click on the tab to the left labeled Slides, Recap, or Replay. Also, you can follow us on Twitter at DLine Funds. A couple of media announcements. DoubleLine was awarded the Financial Advisor IQ Service Award, Bronze Medal for our audio and visual content on September 29th, 2021, so be sure to check out our podcasts and YouTube channel. Our podcasts are Monday Morning Minutes hosted by portfolio manager Sam Lau and Jeff Mayberry. They record on Friday afternoon, and the recordings are available for your commute on Monday morning or anytime in between. The Sherman Show, hosted by Deputy CIO Jeffrey Sherman and portfolio manager Sam Lau, was nominated by Business Insider in 2020 as the 10 must-listen-to podcasts. You can sign up for both of these podcasts on DoubleLine.com. They're also available on iTunes, SoundCloud, Google Podcasts, Spotify, and Stitcher. Their Twitter handles are at DLine Minutes and at The Sherman Show. Also, our YouTube channel features our videos and webcasts, including DoubleLine's Channel 11. You can follow Channel 11 on Twitter at DLine Channel 11 with portfolio manager Ken Shinoda. So with that, I'm going to turn the webcast over to Bill Campbell. Bill, welcome.
Great. Thanks, Barbara. So the title of our webcast is The Long Road to Recovery. And I think the best place to start is with an update of where we are in the COVID-19 pandemic. I think the natural place to start today is the vaccination rates that we've seen increasing across the globe. As we can see from this chart from Our World in Data, vaccine rates have surpassed in a lot of countries 50% of the population. In some cases, it's quite higher. This has led to the expectation that we should have had a durable reopening of economies, as the vaccines were the precursor to that. Unfortunately, there are a couple of areas that we need to kind of keep an eye on. We all know that we just went through the Delta wave across the globe, which caused a lot of economic shutdowns. But in the United States, for example, we see cases have been starting to fall, and subsequent reopening measures have been happening. Unfortunately, when we look at other areas of the globe, the evidence is, maybe not quite so clear. One of the concerning areas that we're keeping an eye on here is Europe, especially the Northern European countries and the Eastern European countries. Germany, when we look at the German rates today, are at the highest case levels on a per capita basis that they've been at since the beginning of the pandemic. Same with Austria, and we're also seeing spikes in Switzerland and Norway as well. That's something to keep an eye on because one of the items that have been talked about in the popular media is the potential for a winter pickup in COVID. And it's interesting that the southern countries such as France, Italy, and Spain haven't seen the same case count pickup that have been seen across the northern countries in Europe. So something we're monitoring closely there. Similarly, when we look, let me go back to this other chart. We also have seen pickups in Eastern Europe in the case count, especially like Russia, the Czech Republic, Romania have all seen cases rise as well. But on the positive side, when we look at the death counts outside of Russia, have remained relatively subdued so far. But I will caution that a lot of these new pickups in cases are recent. So we need to keep a very close eye on what happens in Europe in the coronavirus in the coming months. Also, another area of concern, in our global COVID monitoring is China. Now, China has a very low nominal number that they report. I believe right now, the number of new COVID cases is just over 800, which seems very small for the size of their population. But that being said, China's seen cases appear in 20 different provinces. China has a zero COVID policy, and what they are doing is they're implementing some lockdown measures, strict testing measures, and the concern is that as this new wave in China continues to progress, it's something to keep an eye on as more economic lockdowns may follow. So despite the low nominal number, the fact that we've had wide regional spread and the fact that we're seeing fairly aggressive policy responses from the Chinese authorities would suggest that maybe this is an outbreak that is something we need to keep an eye on from the global growth impact. Now, one of the biggest fallouts, I would call it, from the COVID-19 pandemic has been the rise in global inflation. Here we've just put together some measures of inflation across developed and emerging markets. And what we can see is that the current inflation rates, these aggregated rates, what we're looking at here, are among the highest that we've seen on historical record, especially with the developed market index. Now, this is headline. When we move to core CPI, which strips out some of the more volatile measures such as food and energy prices, it becomes more pronounced that we're seeing, very large spikes across developed markets, especially in the U.S. and the Eurozone. Interestingly, though, in emerging markets where inflation has been kind of a persistent issue that they've had to deal with, although we are seeing a spike right now in the core CPIs, it isn't at 10-year highs. It is still at the upper end of its 10-year range, but it isn't breaking the highs like we're seeing in some developed markets. Now, one of the reasons for this big increase that we're seeing in inflation is due to supply chain bottlenecks. What we're seeing here is with shipping or container ship earnings, but it also is a proxy for the cost of shipping. And we can see that it's absolutely skyrocketed since the start of the pandemic. Here we can see measures of port congestion by different regions. What pops out to my eye here is that where the most congestion has occurred has been in the Western United States or the Western North American region. And what we see is that that's really the supply chain shipments from China to the United States. Now, there are several reasons for this happening. Obviously, there's been lockdown measures due to COVID. There's been labor shortages due to COVID as well. And we just continue to see more and more backups, especially, in the ports down here where we are in Los Angeles. And that continues to put upward pressure on prices, at least for the near term. But it's not just been the supply chain bottlenecks that have caused inflation. We're also seeing commodity price inflation. Here we see indexes that are looking at metals, food, and petroleum spot prices. The first item that jumps off is just the explosion in the price of metals. And I think that, that is something to keep an eye on, as that can start to feed through to housing and, infrastructure as well, when we start to see more infrastructure being put forward on the policy agenda. What is also interesting to me is the bottom blue line, which is the average petroleum price as calculated by the International Monetary Fund. And we can see, despite the fact that we've had a very large increase from the COVID pandemic starting in 2020 to today, we really haven't seen price increases that have gone above prior experiences in 2017 and 18. And, when we look back farther, we have not taken out those peak petroleum prices yet. But one area in the energy market to keep a very close eye on, and that we remain, vigilantly watching here at DoubleLine, is the European power crisis. What we're seeing in Europe is a lack of coal and natural gas. A lot of that is, there are a couple of main reasons, for these shortages that we're seeing, especially across, coal. The first, reason is obviously the decarbonization efforts that are happening across the globe. Secondly, there was a very, severe winter last year that ate into a lot of the energy supplies leading into this year. Europe is dependent on Russia and Gazprom, Russia's largest energy producer, for the majority of its natural gas needs. This year, Russia and Gazprom have been very slow at increasing supplies into Europe of natural gas. A lot of this, has been blamed on the fact that the new Nord Stream 2 pipeline has been completed, and it is not yet completely approved for operation. So Russia may be playing a little bit of a geopolitical game in order to get that pipeline up and running to secure its foothold as the natural gas supplier in Europe, and also to bypass Ukraine, where it has geopolitical issues and is one of the main pipelines, the current main pipelines into Europe for natural gas. That's just a long-winded way of saying that I think that the power issue and the price increases on the power side in Europe are probably going to remain longer, leading into this winter. And as these prices of coal, natural gas, and power pick up, eventually energy producers are going to look for other sources of energy, and that can pull oil higher as well. We mentioned that there's a focus on, reducing the global carbon footprint across most governments. But what this has really led to is an underinvestment in fossil fuel supply. Here we have a JP Morgan study that estimates that CapEx in the fossil fuels industry has, fallen short by about $600 billion so far, and likely to continue to fall short of where global demand will be, going forward. A lot of this has been due to the uncertainty about the regulatory environment for, engaging in long-term capital expenditure projects in, such fossil fuel industries such as deep water drilling. We think that this is going to be a structural headwind for commodity prices going forward, and that will keep them, I should say, a tailwind, which should keep the commodity prices, especially, fossil fuels, higher, as we don't see this trend changing anytime soon. Food prices have also been a concern recently. We've seen the rise of food prices across both developed and emerging markets. Some of this has been due to weather conditions. Others has been due to some of the issues that have come out of the COVID-19 crisis. So we're starting to maybe see a little bit of a peak out in emerging market food inflation. Developed market food inflation is approaching its recent highs, and it's something that we continue to monitor as well. And what this has done is this has really caused realized inflation, especially in emerging markets, to push right up to the inflation expectations of investors and market participants. Now, as you can see on this chart, the light orange line is the expectations for inflation 1 year out, and the blue line is the actual inflation rate. And historically, there's been a deviation between the two. Today, there is no deviation. So this, to me, would suggest, and I think we need to watch closely, that we could start to see more inflation be priced into markets, as now that inflation has met the expectations for 12 months ahead, future inflation expectations should likely rise, and then that is likely to feed through to wage demands. And wages, as we know, tend to be more sticky. So the inflation narrative that I just went through and the sticky inflation has been one of the surprises of kind of the second half of 2021. And what this has caused is policymakers to respond to it. In developed markets, we've seen a dramatic shift very recently in the past quarter from more of a dovish policy stance to a hawkish policy stance. Not only in the United States have we seen, the Fed announce their, tapering of, their asset purchases, we've actually seen hikes across several central banks in developed markets, as well as a lot of hawkish forward guidance, shifting, policy expectations to a much more aggressively hawkish setting. In emerging markets, we've actually seen this for a little bit longer, pretty much since the start of the year. Now, as you'll recall on the inflation chart that I presented before, inflation has gone up to these levels before in emerging markets. In emerging markets, central banks are used to dealing with these inflation concerns, and they tend to be a little bit more proactive than their developed market counterparts. Here we can see that across the different regions, the Latin American central banks have been the most aggressive in responding to inflation outcomes. Here is the G4 central bank balance sheet expansion that we've, really saw an explosion of this since the March 2020 COVID crisis. Now, I put this here because I expect this to level out and flatten going forward as the Fed has announced quantitative easing. We're expecting the ECB not to extend their pandemic purchase program once it ends. Yes, there'll be a little bit of an adjustment to their traditional asset purchase program, the APP, but they're going to be reducing the pandemic purchase program when that happens, and we expect the Bank of England to reduce their program as well. So what this has all led to is a tightening of financial conditions, and this is just one measure of financial conditions calculated by the Reserve Bank of New Zealand, where they're looking at what they call the shadow rate, and this is for the U.S., but it's pretty similar across the globe. And what we're looking at here is a market implied measure that tries to take into account not only interest rate moves, but also balance sheet moves and forward guidance to get a sense of, how hawkish or how dovish the central bank is being. And what we can see is all this year, there has been a tightening of financial conditions, from about an estimated minus 250 basis points to almost flat today. So all of that is, fairly tight, has been a change in the posture of global central banks from dovish to hawkish. And what that has done is it's had a knock-on implication to global growth. And what it's doing is it's going to be a headwind to global growth in the near term, which I'll get to in a minute. What we're looking at now is just the IMF projections of what global growth is or what is likely to be for this year, 2020, and next year, 2022. What we can see is that across the world, there has been a strong rebound from last year's COVID shock, but that growth is expected to moderate going into 2022. More concerning when we zoom in is that the most recent readings since about September of global growth momentum have been slowing. So let me just take a step back and talk about what this chart is. This is the Citi Global Economic Momentum Index broken out by regions. The emerging markets are in purple, the G10 is in blue. And what this does is if the index is increasing, what we are seeing is sequential economic data improvement across the various regions. And if it's decreasing, it's sequential economic data slowing. And now what we can see is that across the globe, the economic data is slowing. And that actually has coincided with the change in central bank policy stance, which I just outlined above, from dovish to a more hawkish stance today due to the rising concern about more persistent inflation. Another headwind that we need to keep an eye on going forward are debt and deficits. And, as we know, debt and deficits tend to reduce the overall long-term economic growth prospects for for economies. And this is an IMF study, and let me just point out two key takeaways. When we look at the two charts on the left, we see advanced and emerging market economies. What we can see is that the red line are the projection for gross debt as a percentage of GDP, and the blue bars are the projection for the overall government deficits. What we can see is that debt has absolutely exploded in advanced economies and is expected to remain very high going forward. There's not a lot of expected improvement, and the reason for that is although the crisis era budget deficits are expected to improve somewhat, a persistent budget deficit is expected for advanced economies. In emerging market economies, the situation is a little bit more bleak. We see that there isn't a leveling out in the red line, or that the debt to GDP is expected to continue to rise over the forecasted horizon, and that's due to the very large expected budget deficits for economies in the emerging markets. Now, no discussion of growth would be complete without discussing China, and China has a lot to talk about. China has been slowing recently, but the China slowdown actually started at the turn of this year when Chinese authorities had decided that their growth was strong enough to withstand a reduction in credit to the economy. Now, the Chinese economy is very sensitive to the amount of credit that is pumped into it. And the contraction in credit that happened in Q1 into Q2 of this year, has been a first-order driver of bringing growth rates slower in China. The second thing that's happened more recently over the past quarter has been a fairly strong regulatory reset that's happening across China. Now, this is happening because I believe this is setting up for October of next year, October 2022, which I'll get into in a second, but I'll tease it right now. President Xi Jinping, is focused on trying to broaden out wealth and wealth equality and prosperity across China. He's also realized that there has been a massive buildup of leverage and debt that needs to be addressed. And I think that when I take a step back and holistically look at the regulatory reform that's happening, it's trying to address those two main issues. And I think you can look at all of the different specific areas of regulation that are happening right now and kind of fit them into those two broad categories. I've broken out several areas of regulation that have become a focus for the government and for markets. The first one is property. So property, what we had seen there is housing was starting to get out of control. There was a lot of leverage, and houses were getting too expensive for people to live in. So now the government has stepped in and is trying to focus on more affordable housing and trying to address the leverage. This has caused a lot of turmoil in credit markets, as Sufei will get into in a lot more detail. But from the policy side, when you take a step back, I think that the policy is focused on addressing those two main issues of affordability and leverage. On the technology side, I think the government became upset that there were several large monopolies in China that were kind of hoarding all their wealth and really didn't accomplish many of the targets that the Chinese Communist Party would have liked them to accomplish. Technology companies were basically platform companies that were focused on large data, and they were not broadly distributing wealth across their worker base. So a lot of the breakup that we're seeing now is focused on getting more wealth distributed, but also their focus is on more national security items, like trying to, instead of being a assembler of technology and more of a data-driven technology country, they wanted to have more of a capability with the focus of building semiconductors onshore. You can read the rest of these. I think those are kind of the two main areas of focus for the markets, but other areas of regulation have been consumption, healthcare, decarbonization, and wealth management products, and you can dive into more of those details if you request the slides at DoubleLine.com. So all of this, the slowing in credit and the increase in regulation, has led to slowing growth, and we've seen this most pronouncedly in the Chinese PMIs, which have fallen below 50, meaning that the manufacturing sector is contracting in its most recent reading. Now, getting back to my comment before that the most important date is October 2022, the reason I say this is the 20th National People's Congress, and this is where Xi Jinping will come up for his appointment to an unprecedented third term in office, which we think is likely to happen. So in order for that to happen, he's going to need to have a fairly strong economy. So what we think is happening right now with all the regulation is he's opening up or putting the plumbing in place that, to be able to distribute credit and wealth to more individuals in early 2022 in order to have a more booming economy as we get into later 2022 and his third term reappointment. Just to repeat, what I'm saying here is I think that the regulatory and credit reset that we're going through right now is likely to turn and become more stimulative in the beginning of next year. So in the beginning of 2022, I would expect to see credit start to pick up. I'd expect to see the regulation start to ease, but the focus on getting more wealth and greater paychecks into individuals' hands in order that you'll have a smooth transition in October of 2022. Well, this idea of using government stimulus to try to help, economic growth is not just, a future Chinese trick. It is actually something that has been used across the board since COVID. And what we see here is that governments have been the main driver of economic growth since the COVID-19 pandemic. And most notably, you've seen the strongest impulse come out of developed markets. So this is through, this quarter, but the question is, going into next year, what should we expect? And I would say we should expect more stimulus. First of all, in the United States, we have the Build Back Better program, which is, there's estimates all over the place now for what the real number is. Maybe it's $1.5 trillion, maybe it's $2 trillion. We also had the infrastructure bill just passed. So that's, another $500 billion. You're going to have a very large fiscal spending package coming out of the United States next year. In Europe, we already have $800 billion plus of the next generation European budget, which is going to be implemented next year. And then, as I just spoke to, I expect China to start both a credit boost and a fiscal boost in early, let's call it either early or summer of 2022 in order to have a robust Chinese economy for that October 22 transition date. So all of that is leading, potentially up to a more favorable backdrop for markets, especially risk markets, in 2022 So now let's switch over to markets. This year, what we're looking at is the U.S. dollar. I'll start with the U.S. dollar. So what we've seen this year has been very choppy dollar price action, but the dollar has, in the second half of this year, trended higher. Now, the reason for that is twofold. First, we had the rise in the Delta wave, which caused a risk-off scare. And then we had central banks turning hawkish, which is, the Fed turning hawkish caused a little bit of a dollar boost. But also, as the rest of the central banks turned hawkish, we started to see that slowdown in global growth, which kept the dollar somewhat elevated. But going forward, we think that the dollar remains vulnerable to a much bigger downside correction. Now, the reason that we say this is it's a little bit technical. So let me try to break this chart down into a very simple explanation. We have a busy chart that looks at global savings and borrowing from across the globe. And it's looking at current account deficits and international investment positions. The current account deficits you can think of as basically trade balances between countries, but explaining the flow of money between one country and another. And then the international investment position is, you think of it more as the stock or the balance sheet. Now, let's just look at the chart on the bottom right, and let's just look at the dark blue lines beneath zero. That shows the United States net international investment position. And what that's showing is a large stock of foreign investment in the United States, and it's the largest by far on the globe. Now, as this is just, you can think of that as a powder keg waiting for a match to unwind and flow out. As long as the dollar remains stable to strong, I think that the large net international investment position will remain. But if we start to see a little bit of dollar weakness, I think that it can have a cascading effect, and all this investment that has come into the United States from Asia, from Europe, from the Middle East, could flow out very quickly and could cause a very aggressive dollar lower move into in 2022. Another catalyst, well, we just talked about the current account, but the budget deficit, the twin deficits tend to be a leading indicator of a move higher or lower in the dollar. And in this case, with widening budget deficits and a widening current account deficit, the impulse should still be for a lower dollar leading into 2022. On a technical basis, we've seen the dollar bounce to several technical lines around 94.50, both the 38% Fibonacci retracement, also the low that we had seen in March 2022. Again, I think that this is fairly strong resistance to keep an eye on. Just in the near term, if it breaks out to the upside, maybe you get a little bit higher. Ultimately, on a structural basis, though, we think that into 2022, the dollar will likely go lower. So far this year, it really has been a dollar higher story, as I said. But if we look at the left, we see that the outperforming currencies have all really been commodity linked. When you look at Russia, Canada, Israel to a certain extent with the natural gas exports, and then Norway, all of those are commodity producing countries. Also, this year has been a story of rising rates, not just in the United States, but globally, both on the front end and the back end, which has made a challenging environment, for global fixed income. But what we think is happening is it's setting up for a very interesting trade in 2022 if we can get a little bit of growth to come back and inflation, pressures to subside a little bit. What we're looking at here are real rates, which are nominal rates minus break-even inflation rates across the globe. And what we can see is that their real rates are at their historic lows. And if there is a little bit of leveling out of, global inflation, I think that there is plenty of room, to see a little bit of rally across international yield curves. Moving on now to the global bond fund performance. When we look at the 1-year performance, we can see that the fund was down 3.4%, which is basically in line with this index, the FTSE World Government Bond Index. We, over this time period, have maintained a lower duration at 6.7 years versus about 9 years on the index. But this, we currently are favoring a fairly defensive position. We have 100% investment grade countries in the portfolio, in our portfolio today. When we look at the breakdown of regions, you can see that we are a little bit overweight some non-United States Americas, and that's been like those commodity plays, whether it's been Mexico or Canada. We've also favored commodity plays in Asia, where you can see developed Asia is a little bit overweight at 5.2% versus 1.9%. So again, those would be some of the commodity-linked countries there. And, we're waiting, right now we're kind of balanced against the dollar, and we're waiting for a little bit more of a dollar lower impulse before we start getting more aggressive in adding to the non-dollar positions in this fund. Moving on to the Emerging Market Local Currency Fund, the last year we've basically been flat. The index has been up 2.6%, and a lot of the underperformance is due to underallocations in Russia and China, which I'll get into in a second. Similar to the Global Bond Fund, we've had a lower duration at 4 years versus 5 in the index. And when we look across, you can see that we're pretty much matched up regionally, across each of the different regions between the fund and the index, with the Americas online. You can look at the CEMEA region is a little bit lower. That's due to a lower allocation in Russia. And the concern there is we've, been concerned about adding too much to Russia in case additional U.S. sanctions came through. So we're using policy banks to try to get exposure without having sanctions risk exposure in the fund. But that's kept the weighting a little lower than the index. And then similarly in China, we've been a little bit lower than the index. And again, that's due to the fact that we are concerned that if there is if you do have the worst case and there is an accident or a financial hiccup in China, that their capital account, which is currently closed to domestics, could be closed to foreigners, and we wouldn't want to trap capital inside of China. So similar to what we're doing in Russia, we're using policy banks to gain the exposure, but not put the fund at risk of potential capital controls there. And so with that, I will turn it over to Sufei to go over the emerging markets.
Thank you, Bill. So during my portions of today's webcast, I would like to cover the following areas. One, to show the EM countries are on the path to recovery from the pandemic. And two, to discuss some of the near-term headwinds facing the asset class. And three, review some of the EM macros and why we remained constructive on the asset class. And four, review the fund's DBLEX and DBLLX. And lastly, talk about the global risk and the outlooks. So as the title of this webcast suggests, the road to recovery will be long and uneven for EM countries coming out of the pandemic. Developed countries relative to emerging markets have had greater fiscal and monetary firepower to help offset the growth impact of the COVID-19 pandemic. Beyond that, developed markets also were able to reopen their economies at a faster pace than emerging market countries, given that they were the first to procure and distribute the COVID-19 vaccines to the population. And as a result, the growth differential between EM and DM economies that we see here narrowed substantially through 2020 and 2021 from the pre-pandemic years. Going forward, we expect the growth differential between EM and DM economies to begin to widen in favor of EM as COVID-19 vaccinations rates have meaningfully picked up across EM. So as Bill mentioned, here we see EM COVID cases have fallen meaningfully from the summer peak, where cases in India surged with the Delta variant. This next slide shows the recent rapid progress emerging markets countries have made in the past few months in catching up to developed markets with regards to vaccinations. The chart on the left shows that outside of a few EM outliers, Israel and the UAE, which had a jump on many developed countries with regards to procuring vaccines for their people, were early leaders. Most of the EM countries in March this year were in single digits. Moving forward 7 to 8 months to November 3rd, when we last downloaded the data, we can see that EM countries have made significant strides with the vaccination rates. For instance, Brazil from 6.6% in March to 74% currently, and South Africa at the bottom on the left at less than 0.5% to increase to 26% as of November 3rd. There is still room for growth for some of the EM countries, such as Russia at 39% and South Africa at 26%, as vaccines become more readily available, and we expect to see vaccination rates that continue to rise rapidly in the EM countries. Here, we see credit spreads for EM and U.S. credit products have compressed significantly from the COVID rise that took place largely in March of last year. Currently, EM credit spreads are not back yet to pre-pandemic levels. We see here the NBIG, which is the EM sovereign dollar index, at a spread of 357 bips at 9:30. It's still 66 bips wider from year-end before the lockdown was implemented around the world, while the SANBI, which is the EM corporate dollar index, is still 34 bips wider. On the other hand, credit spreads for both the U.S. investment grade and U.S. high yield have fully recovered and are even tighter than pre-pandemic levels. The lack in EM credit spreads recovery relative to U.S. makes sense to us, given that EM economy's recovery started later. So separate from the COVID cases and vaccinations, Some of the near-term risks we are monitoring are the debate on the transitory nature of the inflation that Bill just covered, and the potential for rising U.S. rates, Evergrande and China property sector, and EM's heavy political cycle. We have been consistently being asked about the impact of rising U.S. rates on the EM asset class. On this slide, we would like to highlight the relatively low correlation of the EM asset class to U.S. Treasury rates. The table we see here is a correlation matrix put together by J.P. Morgan to show the correlation of its EM debt indices to U.S. Treasuries and other asset classes using monthly return data from December 2003 to September 15, 2021. Notably, the correlation of the SEMBI broad, which is the EM corporate index, to U.S. Treasury was 0.11, while the correlation of the MBIG, its EM sovereign index, to U.S. Treasuries was 0.18, while the highest correlation to the U.S. Treasury was the Julie, which is the J.P. Morgan U.S. investment grade corporate bond index at 0.5. But of course, the speed and magnitude of rate moves matter. In 2013, during the sharp backup in rates during the taper tantrum, emerging markets debt underperformed. However, we would like to highlight the duration management of the fund DBLEX during these times. In 2013, we had shown the duration of DBLEX ahead of the rate backup, helping the fund to outperform by 280 bps in a very down year. And again, this year, as we saw a sharp rise in the U.S. Treasuries in the first quarter of this year, the fund's shorter duration going into the first quarter led to the very strong outperformance of nearly 340 bps through 9/30/21. Of course, past performance is no guarantee of future performance, but it's important to highlight the duration management of the fund during these more volatile rate rise periods. Another risk that we want to highlight is the recent volatility we are seeing in the Chinese property sector. Certainly, we have all seen and heard the news surrounding Evergrande, a Chinese property developer, and its cash-strapped problems with around $300 billion of liabilities. Evergrande's weak fundamentals and a highly levered balance sheet have been known to credit risk to investors for a while. What spiraled out of control for the company recently stems from the tight regulations implemented in the second half of last year by the Chinese policymakers in an effort to rein in leverage in the property sector. These regulations have put tremendous pressure on Evergrande's liquidity positions. The company has had to sell properties at discounts in order to generate cash to pay its bills. Furthermore, the company recently averted a default on its U.S. dollar bonds by making coupon payments on the last days of their grace period. The company still has a significant amount of debt obligations in the coming weeks and months. The company has called on Evergrande's owner to use his personal wealth to try to fix the liquidity problems at the company. And so we have seen Evergrande's chairman recently unloaded 2 of his personal jets, raising about $15 million. In addition, the company has been trying to sell some of its assets, but it has not been easy. So in our view, we believe a debt restructuring is unavoidable. The Evergrande bonds are trading in the mid-20s to low 30s. It is difficult to derive the recovery value due to the company's sheer size and diversified assets. So the Evergrande situation has led to a lot of negative investor sentiment and nervousness around the Chinese property sector. In addition to concerns relating to Evergrande, there have been a number of defaults by several smaller developers in recent weeks. It has raised questions of the developers' willingness to pay and liquidity pressures from potentially hidden liabilities. This has also led investors to question the transparency and reliability of the developers' reported financials. Company can raise off-balance sheet financing that may not show up in financials, but can stress liquidity. Often, assessing these items can come down to direct communication with the company and the level of transparency and openness with which the company provides investors. Investors are also concerned about the liquidity situation of weaker property developers who may not be able to refinance upcoming maturities. This in turn could potentially lead to a higher number of defaults in the coming months. We will also be carefully monitoring the sector's significant maturity wall of U.S. dollar bonds in the next 3 months, with the capital markets essentially shut to developers given where the bonds are trading. Complicating the situation is that offshore dollar bonds can only be refinanced with offshore bonds or repaid from cash flows. They cannot be refinanced with onshore bonds. So what this means is that the developers would need to come up with cash to meet the upcoming maturities, which is around $9 billion in the next 3 months. So investors have been asking whether the volatility in the Chinese property sector has spilled over to the broader EM asset class. Here we can see the small widening in EMFI yield spread. That's the line in red in the chart, where the China high yield spread, the line in blue, have significantly widened to over 200 basis points in the past month. So we are not seeing a contagion yet to the broader EM credits. That said, there has also been a relatively indiscriminate sector-wide sell-off, suggesting a lack of differentiation in U.S. dollar China property credit, more pronounced for the Chinese high-yield names. We believe that while leverage and credit conditions across the space are certainly challenged right now, certain companies are better and are more defensively positioned than others, and there will be winners and losers that emerge. So given the importance of the sector to the Chinese economy, making up around 25 to 30% of the country's GDP, we expect the government would want to maintain stability and prevent contagion. So what do we expect to see going forward? We expect marginal policy easing, the easing of financial conditions onshore by Chinese banks, reducing regulatory red tape around shifting cash offshore for refinancing purposes. So after a recent U.S. dollar bond default by one of the Chinese developers, the messaging from the Chinese government was clear that offshore maturities are to be respected. So as such, several distressed companies have been offering extensions while keeping par principal intact rather than simply not paying. So investors, I believe investors will have to accept these distress exchanges and or maturity extensions simply because they don't have a choice. They could face default or face an uncertainty of a full-blown debt restructuring. It is important to remember that the U.S. dollar bond holders are deeply subordinated to developers' onshore obligations. The government is being careful about maintaining a balance between verbally supporting the sector while not bailing out individual developers. We continue to expect the government to rein in the property sector from the excessive growth that led to the problems being seen today. Weakness around the sector will likely continue. It will take time for confidence and liquidity to be restored in the property sector. Home sales numbers will need to improve, and companies will need to deliver. And lastly, I would like to leave you with 2 thoughts. One, we do not have Evergrande or any of the Chinese property exposure in DBLEX or DBLLX, the funds that we're discussing today. And two, just to remind you again that the Chinese high yield significant spread widening has not carried over to the EM high yield space as a whole. So now turning to EM's heavy political cycle, Latin America has been under pressure due to rising political risks across the region. In Brazil, President Bolsonaro has been facing declining popularity due to his handling of the COVID crisis, inflation, and the economy. He is likely to face a tough re-election heading up against former President Lula. The embattled president has been trying to walk a fine line of extending and increasing social fiscal transfers to shore up popular support while maintaining a fiscal anchor. On the other hand, for many investors, a return of Lula will represent a shift to the left and returns of higher fiscal pressures for social programs. In Argentina, legislative elections will be held this Sunday, November 14. The ruling coalition had just suffered a defeat in the primaries this past September. The Fernando administration has responded to the loss of its party in the Senate by further accelerating unorthodox measures. In Chile, general elections will be held November 21st. We expect a strong showing from the left-wing candidate, Gabriel Boric, who would mark a sharp shift in policy from the current government. Further uncertainty surrounds the redrafting of Chile's constitution, which could embed permanently higher social spending within the constitution. Colombia will hold legislative and presidential elections next year. Leftist candidate Senator Gustavo Petro is leading in the early polls. In Peru, a surprise presidential election resulted in Pedro Castillo from the far-left Peru Libre Party being elected. However, in his first 100 days in office, he has moderated from his campaign promises, indicating that his government will govern more to the center. So although we see these upcoming elections as potential headwinds to our continued recovery into 2022, that said, we have also seen over the past 20, 30 years the elections of many different leftist and populist presidents governing more from the center once they're in the office, as in the case of former Brazil President Lula and current Mexico President López Obrador. So in the next few slides, I would like to go over why we think EM is on this long road to recovery and why we remain constructive on the asset class. So this slide here shows historical and forecasted growth across EM's regions. We see all regions suffer from negative growth in 2020 due to the pandemic. Latin America was particularly hit hard and was seeing already subdued growth rates pre-pandemic years. EM Asia was the least impacted as China was able to guide its economy through a managed slowdown, printing a positive 2.3% growth rate that year. That said, all EM regions are now enjoying a sharp rebound from the pandemic lows in 2020. Though the recovery appears to be losing steam, and while growth is still forecasted to remain above trend for 2022, it will slow meaningfully compared to this year. That said, EM growth rate will continue to outpace that of developed markets. So EM fiscal balances deteriorated during the pandemic. Widespread EM economies saw a sharp decline in tax revenues due to the economic shutdown, while fiscal stimulus measures were more differentiated across individual countries in 2020. EM fiscal balances are improving in 2021 and are also expected to continue to improve into 2022. But EM governments will need to commit to a strong fiscal consolidation plan and in order to return to pre-pandemic deficit levels. So no surprise, with the wide fiscal deficits and contracting GDP, EM economies saw a sharp rise in their government debt ratios in 2020. EM saw government debt jump from an average of 54% of GDP to over 63% of GDP in the course of 1 year. Thanks to the strong 2021 rebound and tax revenue recovery, it appears that debt ratios have stabilized. But again, EM governments will need to commit to a strict fiscal consolidation plan to return the debt ratios back to pre-pandemic levels. So now we turn to EM corporates. EM corporates fundamentals have recovered from the pandemic when net leverage and interest coverage figures were at or near the weakest level in 14 years. Over the last 12 months, we have seen both investment grade and high yield emerging markets net leverage ratios fall. For EM investment grade from 1.7 times in 2020 to 1.3 times last 12 months, and for EM high yield from 3.2 times to 2.3 times. In fact, EM investment grade and high yield net leverage figures actually improved to levels last seen in 2018. This improvement has been primarily due to a recovery in EBITDA from a weak 2020 pandemic-impacted year. Further support for the improvement has come from companies remaining cautious on CapEx spending and CapEx-related financing. Lastly, a strong commodity pricing cycle has provided additional tailwinds to companies' overall EBITDA generation. So year to date, we have seen a solid rebound in both investment grade and high yield EM interest coverage ratios. Not only do we see a rebound in interest coverage in 2021 versus 2020, but levels reached so far this year haven't been seen since 2012. This improvement was largely the result of improved EBITDA figures, as I just mentioned in my comments regarding net leverage ratios. Again, these ratios were aided by strong commodity prices. Our next two slides compare EM interest coverage and net leverage ratios with U.S. and European corporates. We see once again that the net leverage figures for EM companies are better than our peers in the U.S. and Europe in both the investment grade space, the chart on the left, and the high yield space, the chart on the right. So emerging markets interest coverage ratios have typically been a little weaker than the U.S. and European peers, both for investment grade and high yield corporates. Although we can see that EM interest coverage ratio have now migrated closer to the U.S. and European peers, especially in the high yield space. So EM default rates have generally remained low over the past few years, and they have come down from elevated levels we saw during the pandemic last year. Default rates for both EM and DM have all declined year to date, with the default rates currently at 1.7%. It is currently higher than U.S. and European high-yield corporates, which are currently below 1%. The EM default year to date have been primarily concentrated in Asia and LATAM corporates. Going into the remaining of the year, EM default rate is expected to jump to 5.5% for the full year 2021, on the back of further defaults to come from the Chinese property sector. We saw these similar elevated defaults in 2016 of 5.1%, driven by the commodity crash in 2015 and 2016. Lastly, I would note that the expected default rate of 5.5% for EM high yield component this year which translates to about 2.5% or so for the SMB index as a whole, as EM high yield components makes up 45% of the EM corporate index. As I just mentioned, Chinese high yield defaults are overshadowing the improving credit trends we are seeing for the broader EM corporates in 2021. Chinese high yield defaults are forecast to hit 13% this year. This number assumes Evergrande defaults on its $19 billion publicly traded U.S. dollar bonds this year. So far, we have seen the company struggling to stay current on its U.S. dollar obligations. Excluding the Chinese high yield default, the default rate for EM high yield corporates would be expected to finish 2021 at 1.8%, only slightly higher than the 1.7% reported year to date. So turning to gross issuance, both gross issuance and net financing are expected to increase in 2021 versus 2020. We have been pleasantly surprised that the new issues have generally been well received and absorbed by the market, despite the record high issuances from EM corporates and sovereigns. On average, new issues have been 2 to 3 times oversubscribed. We are expecting around $550 billion of new corporate issuance for 2021, while the net financing is expected to be only $97 billion. What this means is that companies were expected to come to the market and issue $550 billion of new bonds this year. However, of that amount, over $450 billion was expected to be used for tenders, calls, refinancing, and buybacks. So net supply is only $97 billion, which have been well absorbed by the market. JP Morgan was forecasting inflows of around $70 billion for 2021, slightly higher than 2019 pre-pandemic levels. However, high inflation and rising rate concerns, supply chain disruptions, and global China slowdown, we could see slower inflows, even outflows, going into the end of the year. So inflows could end the year somewhere between 2019 and 2020 levels of $67 billion and $23 billion, respectively. Year-to-date inflows stood at around $50 billion through 9/30. In October, we did encounter outflows in the back of the volatility of the Chinese high yield space. That said, the trend has reversed, and we have seen inflows over the past 2 weeks. We have seen improvements in technicals and fundamentals from last year. So what are we seeing in terms of valuations? In this chart, we see that the MBIG, that is the EM sovereign index in red, and the SMB, which is the EM corporate index, in blue. The sovereign index is at 360 bips, 8 bips wider than the beginning of the year, and the corporate index is at 272 bips, 2 bips wider than the beginning of the year. Given the improving backdrop we have just discussed, that it's improving growth, economies reopening, strong commodity prices, valuation looks fair to attractive, and that's why we remain constructive on the asset class. We think there is room for credit spreads to grind tighter. We believe there is more room for the sovereign spread to grind tighter than the corporate index that we show here. We expect credit fundamentals to improve over the next 12 months due to improving growth and strong commodity prices that we talked about, and that coupled with spreads that are still above the historical average for the sovereign, we see room for spreads to compress for the sovereign index. So now, turning to the funds review. Looking at DBLEX performance 1 year as of 9/30/21, the performance has been solid in spite of a challenging year with the uncertainty of Delta variant. The iShare posted a return of 7.52%, outperforming its benchmark, which is the MBIG. You see here with a return of 4.36%, so a 316 bips outperformance. For comparative purposes, the fund also outperformed the SAMB index, which posted a return of 6.03%, and the GBI with a 2.63% return. Here we have the fund's performance since inception and our one-year performance that we just talked about in the prior slide. We have always said that the asset class is a secular improving credit story, and it can deliver in the mid to high single digits return. So the 5.5% average return since inception demonstrates that. This chart indicates our performance against our benchmark and against our peers, showing the funds primarily in the top quartile against many of the period buckets since inception. We had a great 1Q, which showed over the last year. This chart shows our relative performance from a risk-adjusted basis against our benchmark and peers. It also indicated that we have performed in the top quartile for many of the period buckets since inception. So moving to the portfolio summary and how we're positioned currently and the changes from a position at the end of 3/31, discussing our May webcast. The position changes since first quarter are as follows. Duration continued to increase to 7.65 years at 9/30 versus 7.27 years at 3/31. Investment grade credits increased to 67% from 61%. Double B credits dropped to 18% from 24%. Single B credits remained relatively unchanged at around 13%. Sovereign credits increased to 35% from 31%, while corporate credits dropped to 51% from 54%. And quasi-sovereigns were relatively stable around 12%. Let me discuss a little bit more about our current positioning. The duration of the fund is at 7.6 years. It's roughly in line with our benchmark of around 8 years. Recall when we started the year with a duration of around 4 years and stayed around the high threes until mid-March. We started to lengthen the duration after the move in the 10-year Treasury from 0.91% to above 1.7%, since the expectations for highly sharply rate seems to have gotten ahead of the Fed. Positioning the fund with a shorter duration during most of 1Q allowed us to capture the outperformance relative to the benchmark. Our expectation is that the 10-year U.S. Treasury yield is going to stay range-bound for this quarter. We repositioned the high-yield corporate bonds and shorter-dated investment-grade corporate bonds into investment-grade sovereign bonds for several reasons. One, due to relative value, and two, to increase the overall liquidity of the fund. And also, as we want to be able to take advantage if there are better entry points into other credits. So investment-grade credits and sovereign bonds tend to be more liquid, which should allow us, one, easier to sell to meet redemptions in need be, or two, to reposition the portfolio if future opportunities arise in other credits or in the new issue market. So regarding the portfolio distribution, sovereign exposure is the largest allocation, which I have discussed in the prior page. As we have talked about in our webcast, the portfolio will generally have a heavier exposure to the strategic sectors of the economy. By that, we are talking about the utility, the banking, the oil and gas, telecom, and natural resources, which you see here have higher allocations. Generally, these five sectors will represent about 2/3 of the portfolio. So let's move to our low duration emerging markets fixed income fund, DBLLF. The performance over the 1 year ending 9/30 of 2.05% for the iShares is below that of its benchmark, the JP Morgan SMB Broad Diversified 1 to 3 year maturity, which posted a return of 5.81% for the same period. Although the fund underperformed relative to its benchmark, we believe the fund has performed the way we expected it to. By that, I mean the fund is meant to not only to have a low duration and an average life in terms of maturity profile, but it's also meant to be a low volatility strategy. The performance is below its benchmark since inception and over the past year. As mentioned on the last slide, we are comfortable with the performance of the fund for what we're trying to provide to our investors, and that is a higher quality with lower volatility fund. The lower return of this fund is to be expected, as our focus for DBLLX, as we have mentioned in the past, was to provide investors with an EM low duration option with higher credit quality. The fund currently is 80% investment grade at the end of the third quarter versus its benchmark at 56%. This shows us here at the bottom of the quartile of this peer group since inception. However, again, we are comfortable with the returns we're providing to investors as it is, as I had mentioned already, a higher credit quality portfolio. This slide shows DBLLX in the top quartile since inception versus our peers from a risk-adjusted basis. Again, this is because the fund has a lower volatility due to the higher portfolio quality. So I'd like to go over the position changes we have done since first quarter when we discussed it in our last webcast. Investment grade credits declined from 83.5% to 80%. This is due to adding a few high yield names with attractive values. Double Bs increased to around 13% from 8%. Like I just mentioned, we saw some attractive opportunities in some B credits. Sovereign exposure remained relatively unchanged at 16%, and corporate and sovereigns increased marginally from 75% in the first quarter to 79%. Cash declined from over 7% in the fourth quarter to 4.7% as we deployed the cash into some high yield opportunities. The largest country move would be the increase in the Peruvian exposure from around 5% in the first quarter to over 10% in the third quarter, as we took advantage of the market volatility stemming from the presidential election to position into some of the credit dislocation. Here, there's not a lot of change in terms of the industry breakdown from first quarter. Corporates increased slightly from 48% to 53% due to the deploying of some cash into the Peruvian credits. Similar to DBLEX, the strategic sectors will tend to be well represented in this portfolio too. We see banking, utilities, oil and gas, telecoms, and natural resources were among the top 5 corporate sectors. So as we near the end of our webcast, we want to remind investors of the risks facing our markets. The risks that we see in the horizon are growth focused and could lead to uneven or incomplete recoveries. One, it's the COVID cases and new variants leads to calls for lockdowns and loss of business and consumer confidence and supply chains disruptions. Two, it's inflation could prove to be less transitory than thought. Market could see the central banks behind the curve and push treasury yields higher, hurting risk sentiment, growth, and tightening financial conditions. Three, the market expects the global economy has seen peak growth and the strongest impulse from fiscal and monetary accommodations are behind us. 4 is China's new regulatory reset and slowing credit impulse will weigh on global growth expectations. And 5 is the tightening financial conditions and poor policy decisions could lead to incomplete recovery in EM and rise in social discontent. And lastly, EM's political cycles, idiosyncratic events, and geopolitical flashpoints. So what is our outlook? We expect global outlook to remain fairly benign over the next 12 months. We expect a continued uneven recovery and a healthy discussion of the transitory nature of inflation. Like the uneven recovery, we see an uneven easing of inflation pressures that could continue to keep inflation elevated. Developed market central banks are likely to begin normalizing extraordinary easy monetary policy, though keeping policy rates accommodative until they see a complete economic and labor recovery, as long as inflation expectations remain contained. EM central banks have needed to preempt the Fed in tightening monetary policy to prevent second-round price impacts and an unanchoring of inflation expectations. EM governments had very low fiscal space going into the pandemic and will need to quickly withdraw fiscal stimulus measures to stabilize debt ratios. We think most EM governments will commit to fiscal consolidation as their economies improve, and therefore we expect a stabilization in EM sovereign fundamentals. And additionally, we expect EM corporate fundamentals to remain strong and to continue to improve going into 2022. That's the last slide in this presentation. We did go a little long, so we will take a question or two. So let me turn it over to Bill to take a question.
Okay, thank you, Sufei. And as Sufei mentioned, we've gone a little bit long, but maybe we can answer 1 to 2 questions quickly. I see there are several questions. I'm going to try to bundle some together, but questions on the outlook for global bonds, when we would add emerging market local currency bonds, the outlook for emerging market local currency bonds. It all seems to be, revolving around the question of when the internet, how are we thinking about entering into that international trade, whether global or emerging market local currency. So as I laid out earlier in the presentation, we think that 2022, we're likely to see a couple of factors that, could start to push the dollar lower. Mainly, we do expect to see more government stimulus come in. We expect to see potentially some moderation in the inflation pressures that we've seen in the second half of 2021. And that could allow central banks to ease off. So we think that, that could start, the potential for a bigger dollar lower move. Secondly, we also believe that a lot of value is being created in emerging market local currency bond curves. As central banks have been hiking, inflation has been higher, and risk premium has built up. So you've seen steepening and aggressive parallel moves higher across the emerging market local currency space. And we think that, as the dollar, begins to move a little bit lower, we will see inflows into the emerging market local currency space. So for both of those reasons, we could see a potentially very interesting trade in, let's call it, mid-2022. So the international trade and the emerging market local currency trade would be based on those 2 factors. And hopefully that answers, I see several questions that are kind of revolving around that. And then to kind of wrap up, there's an interesting question on the outlook for China's growth in next year and beyond. And I think really what the question here is, let me break it into 2 parts. For next year, I think we're going to see a tale of 2 halves. I think the very beginning of the year is going to be a continuation of what we're seeing now, a fairly slow growth. But then as we move into the tail part of 2022, there will be a new stimulus, credit stimulus, fiscal stimulus put into place, and an easing on the regulatory reset. After that, I think that growth continues to moderate on a nominal basis. We'll probably see growth at like 5 to 6% for the next couple of years before moderating to 3 to 5% over the longer term. Now, although those sound like lower growth numbers, I think we need to put it in context that China's GDP per capita still remains very low, and they have a very large runway to continue to increase the standard of living in the country, and raise the GDP per capita from about 12,000 per person, maybe up to that middle income, let's call it, 20,000 to 30,000 per person. Now, that would mean that the total nominal growth or the overall size of growth will continue to expand ever higher, but the actual rate or year-over-year change will be lower to the 3 to 5%. So even when I say long-term growth at the 3 to 5% range, sounds a little bit low, actually, it implies that there will be a continued growth in the Chinese economy over the long term. So I think that, that was a fairly interesting question. If there were any other questions that we missed, I'm sure our client services team will respond. And with that, we're going into the holiday season. I wish everyone a wonderful holiday. I wish you good luck into the end of the year. And as Jeffrey usually says, goodbye for now.